There's a hidden signal that the world's biggest financial players are watching with, well, extreme focus. You're not going to see it on the news, but it might just be the single most important economic indicator out there right now. We're talking about the Lloyd's signal.
So let me ask you a question. If you had to name the world's most accurate crystal ball for predicting global crises, what would you pick? Some super complex algorithm? A panel of experts on TV? Well, the truth is, it's none of those. It's something way more direct and, frankly, right now, way more alarming.
It's called the Lloyd's signal. And look, this isn't about opinions or speculation. This is a hard number. It comes from the war risk insurance premiums that are paid for global shipping. It tells us what the experts, the ones who have to pay out billions when things go sideways, really think is about to happen. And that's really the core idea here. While the news is busy focusing on the latest political drama, the real story is being told in the cold, hard math of risk. You see, insurance markets don't guess. They price risk based on intelligence that you and I never get to see.
So, all right, let's follow the money, because this is where the numbers start to paint a very clear and, a very concerning picture of what's unfolding on the world's oceans right now.
Okay, so in a normal, stable world, when things are calm, the standard war risk insurance premium for a big ship is about 0.25% of its value. That's the baseline. It's just the cost of doing business. Now remember that number, 0.25%.
But today, in major hotspots like the South China Sea and the Middle East, that premium has spiked to 10%. I mean, that's not a small jump. That is a catastrophic repricing of risk.
Let's be perfectly clear about what we're seeing here. That's a 40-fold increase. A jump this huge means the insurers, the people with the most skin in the game, are signaling that they expect a major escalation.
So what does this actually mean in real money? Well, let's just take a typical $100 million cargo ship. That 10% premium, that translates into a $10 million bill just to leave the dock. That's before fuel, before paying the crew, before any hope of making a profit.
And the critical consequence of this, as Professor Zhang Suin points out, is that the basic economics of global trade just break down. You literally can't afford to ship low-margin stuff like grain or fertilizer anymore. The math just doesn't work.
This financial signal is actually creating a physical reality. As the money freezes up, the ships themselves are stopping. Those buffers that used to protect our supply chains, they're vanishing in real time.
The scale of this collapse is just staggering. Take the Strait of Hormuz, right? One of the most critical energy choke points on the planet. Daily ship traffic has absolutely plummeted from about 130 ships down to fewer than 6. This isn't a slowdown, it's a total breakdown in a vital artery of the global economy.
So why is all this happening? It's not just one thing, it's a convergence of crises. Over in the Pacific, you've got China's Justice Mission 2025, which has basically erased the shipping buffer zone around Taiwan, putting the entire world's supply of advanced semiconductors from TSMC at risk. At the same time, in the Middle East, Iran is reportedly charging a $2 million toll for every single tanker that wants to pass through the Strait of Hormuz. But this isn't just a shipping story anymore. When you see a signal this strong, you've got to look for other evidence. And right now, another major indicator is flashing bright red, turning this whole shipping crisis into a full-blown recession warning.
So here we're looking at the recession probability model from Moody's Analytics. And as you can see, it's currently at 49%. Now, I know that number might not seem too scary on its own, but you have to understand the history of this model. Over the last 80 years of data, this model has been, well, infallible. Every single time it has crossed that 50% threshold, a recession has followed within a year. No exceptions. We are 1 percentage point away from that trigger. So what does the Lloyd's signal, backed by all this data, predict for your wallet? Well, in the most likely extension scenario, where this uncertainty just drags on, we could be seeing gas prices anywhere between $4.50 and $7 a gallon, with the stock market just in a slow, grinding decline. But if an escalation happens, which is exactly what that 10% premium is pricing in, we could be looking at oil at $150 to $200 a barrel, and another 10 to 14% drop in the S&P 500.
Now look, the point of all this isn't to cause a panic. It's about encouraging preparation. It's about rebalancing for a world that has clearly lost its safety buffers. So, what are some smart steps to consider? We're talking about modest strategic preparedness here. Maybe having a 2 to 3 week supply of non-perishable food on hand. And from a financial perspective, it might be a good time to just review your investments and see if you're a little too exposed to sectors that are super vulnerable to these kinds of shocks. Think airlines and shipping companies. If you take only one thing away from this whole explainer, let it be this. The signs are all telling us that the stable, buffered period of the global economy that we've all enjoyed for decades is over. The system now has far, far less capacity to absorb any kind of shock.
The Lloyd's signal isn't just some number on a spreadsheet. It's a warning. It's telling us that the bill for all the chaos we've seen recently is finally coming due. And it leaves us all with a pretty critical question we need to consider. Are we flying without a